Hello everyone, magandang araw po sa inyong lahat. My name is Mark Ilao, Head of COL Fund Source, and I'll be joining you today as a moderator of this afternoon's edition of COL Conversations. Since we're here today to talk about different stock strategies through mutual funds, allow me to take this opportunity to highlight that today at COL Fund Source, we have 32 mutual funds already. So this year, we've added 5 new funds, and we're looking to add more funds in the future. And as some of you may know, you can buy po any of these funds without any commissions or front-end fees. And by the way, para dun sa mga laging nagtatanong or for those of you who have friends, once you have a COL account, you don't need to have a separate one just to be able to invest in any mutual fund. So isa na lang po yung gagamitin natin. And I'd like to also mention this because this is a usual question that I get. What if you want to invest regularly but you don't have much time to do it? So I'd like to invite you to check out our easy investment program facility. So if you log into your account and go to the COL Fundsource website, you can access it through the Schedule EIP tab. So you can also go to our YouTube channel if you wish to see the step-by-step guide on how to set this up. This will allow you to automatically invest in any of the mutual funds that you want to regularly put your money into. All right, now, as I've mentioned at the start of the program, we've invited a panel of experts to help us dissect the investment environment in 2021. Actually, ladies and gentlemen, we really want to have this opportunity so that you, as mutual fund investors, will get the chance to directly hear from your fund managers, being existing mutual fund investors yourselves, and later on have the opportunity to ask questions directly sa mga taong to. No? So this afternoon, allow me to introduce the experts, the fund managers who will share with us their insights on the market. So first, from ATR Asset Management, we have Mr. Julian Tarrobago. He is currently the head of equities at ATRAM, and he has been in the industry for 23 years now with extensive experience in portfolio management and research. So today we've asked him to give us his take on growth companies and also talk about their fund that focuses on these companies, the ATRAM Alpha Opportunity Fund. We also have from BPI Investment Management, Mr. Michael Enrile, who is currently the equities portfolio manager. And prior to this role, he was a senior equity analyst with Manulife Asset Management and Valiant Security. So he will be giving us later his take on indexing and whether it's a strategy that we can still use for 2021. From First Metro Asset Management, we have Mr. Edser Trinidad, who is currently their head of investment and research. He brings with him more than 25 years of experience in the financial and investment industry. Sir Edser will be sharing with us later his thoughts on the consumer sector, as well as how investors can participate in this sector through the First Metro Consumer Fund. From Philequity Management, we have Mr. Miguel Agarao. He is currently the Vice President of Philequity and helps manage different funds under the firm. He brings with him more than 10 years of industry experience, and he is responsible for crafting and presenting Philequity strategy to clients and investors. So he'll help us make sense of what's in store for active management in today's environment. And finally, last but not the least, we have from Sun Life, Ms. Cristina Gabaldon. She is currently the head of equities and research under the investments department of Sun Life of Canada, Philippines since 2015. She is a fellow CFA charter holder and a seasoned investment professional with more than 8 years of fund management experience handling both equity and fixed income portfolios. So we ask her to share with us later their views and how those views are translated to the Sun Life Prosperity Philippine Equity Fund. So I really invite you guys to ask questions, especially during the Q&A, since we have a panel of experts who can really guide us and help us with our investment journey going into 2021. Now, before we go to each of them, prior to the event, I actually took the liberty to ask these fund managers. So I gave them a survey of their general outlook, about their general outlook for the stock market in 2021. So I asked them 3 questions. First is, where do you see the market in 2021? Secondly, what are the catalysts that you're looking for? And then finally, what are the risks present? So let me share with you ano yung response ng mga fund managers, ng mga experts natin this afternoon. So in terms of the overall direction of stocks, just a very quick review. So we started the year at 7.8, went to as low as 4.6, but now we're back to almost 7,200. So we're now just down by 7.9% year to date and up by almost 56% from the bottom. So some of you may be asking, meron pa ba na itataas yung stock market especially for next year? Well, according to our experts, generally they are still positive for next year. So most of them are actually expecting that the index can still go higher. In fact, one of them said as high as 8,300. So later on, maybe hear from him. Ano yung reasons bakit nakikita nilang ganun? What they are in agreement of is that as in any market environment, it's not going to be a straight line. Some of them also emphasize that while they are looking at fair values na about 5 to 8% from where we are today, they acknowledge that higher valuations are still possible for next year, especially if the positive catalysts really happen. And another thing that they really mention is that there are pockets of opportunities for select companies and sectors. And that's why we tried to bring to you today these guys so they can talk about the different themes, flavors, or strategies that they're looking at for next year based on also on how they are managing their funds. Now, what are the main catalysts? So based on my survey, the ones that I will show initially, ito yung common. And I think as investors, especially if you're really monitoring the market, these are also the same factors that you're looking at. And the reason why we want to share with you these things that the fund managers are looking at so that we get an idea as to how they actually formulate their investment process. We get to have a peek into their minds, kumbaga, kung ano yung dashboard ng mga fund managers na to, so that we ourselves as investors, even if we don't have this kind of live events every now and then, we get to be better investors na nakikita natin, okay, ito pala yung mga dapat tinitignan. So for next year, based on their view, ito yung nakikita nilang factors that will help the market move higher. Of course, the reopening of the economy, as we all know, this year, negative yung growth ng ating GDP. So let's see if we'll have a rebound for next year. The big news, vaccine distribution. So if it does happen, the fund managers believe that the market will have more legs from where it is right now. Obviously, the earnings of the companies. So this year, puro declines yung nakikita natin or net losses. So next year, these experts are expecting most companies to report a positive growth already in terms of their income. Now, here are the factors that I found quite interesting kasi only a few or just one of them highlighted these catalysts that they're looking at. First, fiscal and monetary easing. So, fiscal stimulus, ito po yung government spending. So, tignan natin if the government will really spend more to help our ailing economy, and monetary easing from the side of the central bank. Let's see if they will still continue cutting rates, and that will bode well for our publicly listed companies. Consumer confidence, if people have come back to really going out, spending, we see the velocity of money na andyan na ulit, then according to this fund manager, we really see the index going higher. Foreign flows, another thing. Ladies and gentlemen, so far we have 120 billion net outflow for this year. And I think 90% of the trading days talagang foreign selling tayo. So according to one fund manager, this is something that we have to take a look at. If this reverses, then the market can really go up. And then finally, let's not forget, we are approaching the 2022 national elections. And this could spur more activity in the market, especially if the new normal talaga uh, is here with the vaccine. Now, what are the risks according to these fund managers? So, I think, like I said, yung mga nasa taas, ito yung mga common. So, COVID-19 resurgence, if nakita natin yung new infections, mataas ulit, probably we'll see the market react to that. High unemployment and disappointing GDP and earnings, so opposite of the positive catalyst, and vaccine issues, no? If it's not effective or if it will take a while to really distribute to individuals. And then here are the other risks that fund managers have on their radar. Inflation risk, so that may have an impact on consumption. So yan, consumer confidence and infra spending, if we don't see it come back, then that will pose another risk. And then obviously yung asset quality ng mga bangko, no? So if we continue seeing some defaults, that's not a good news for many banks and listed companies in general. And then obviously another risk that we have to watch out for, yun nangyayari within the global markets. Okay? So having said all of that, very constructive naman yung view ng mga fund managers. And as they say, generally they're positive. So our question as investors is how do we participate in this kind of market? So in the space of the stock market options, marami ka diyang exposures or different types of funds that you can tap. You can either go to a growth fund, a thematic fund that focuses on consumers, a dividend fund, an index fund, or an enhanced index fund. So the job of our fund managers today is to give us more color pagdating dito sa mga investing strategies na to. So on that note, let me start the discussion with the fund managers with Mr. Edser Trinidad. No? Sir Edser, thank you for the time and thank you again for coming to our live event. No? Yeah, sir. Maybe you
Yeah.
can talk about the First Metro Consumer Fund, how you're currently managing it, and generally speaking, can you give our audience an idea how do you see 2021 for a consumption-driven fund?
Hi, good afternoon. Well, the consumer fund is, I believe, is one of few thematic funds that we have here in the market. And basically, this is, as the name suggests, this fund only invests in consumer stocks. Those basically companies that generate at least 80% of their revenues serving or produces products or sell products directly to consumers. We are quite we believe that considering that about 60% of our country's growth is basically driven by private consumption, then I think this sector should really perform well over the long run. I think this stock is basically, or this fund basically, you know, answers to those investors that are looking for something, very specific, um, that can give them some sort of investment in a sector that directly focuses in serving or producing for the consumers. So basically, this is how we design this fund. And if you look at the contents of our fund, most of these funds are most of the companies that we're invest in are basically, the known companies such as Universal Robina, Jollibee, um, Wilcon, San Miguel Food and Beverage, and 7-Eleven. So those are basically, few of the names that we have in this fund, and the rest are basically, well-known brands that every Filipino can easily recognize. Aside from those five names that I mentioned, we also have in our portfolio like Maxis. We also have companies such as Emperador, Ginebra, San Miguel. So those are the companies that we are basically invested in.
Sir Ed, sir, thank you for sharing the composition of your fund. No? I just want to ask you, kasi I'm sure some of our viewers might also have the same question in mind. If you take a look at the performance of the consumer fund for this year, it was largely resilient. In fact, at many points, it was one of the best performing funds, no, given the exposure that you provide. Going into 2021, no, if we see really yung normalization happen again,
Mhm.
do you think consumer companies will still have the same kind of outperformance as they saw this year?
I think, I said early on, when the market was basically, or the economy is basically facing some challenges. you see this fund, I think, had performed well, primarily because a big number of the companies that we hold are so-called consumer staples that basically, had benefited from this lockdown. The companies such as Universal Robina, which I think in a way had also benefited from it from this lockdown. And aside from that, we also have Century Food. They basically these two companies has really benefited from the lockdown, and it has also reflected on their earnings. So in a way, that's the reason why this fund has done well during the times of uncertainties. But nevertheless, going forward, this fund we should also benefit from it, considering that um, as you reopen the economy, um, people will start to be confident, and especially with the vaccine availability is just around the corner. So you'll be basically um, improving your consumer sentiment, and therefore the consumption right now will be towards as from staple to discretionary spending. And so that will basically come into picture the companies like Jollibee. You also have in our portfolio SSI, um, Max's restaurants. So as a vaccine is being distributed and the economy is slowly being reopened, so therefore the limit in terms of going to restaurants should also increase. So therefore, this company should also benefit. I think over the long term, the consumer fund should also perform well. Admittedly, I think that during the past bounce back, most of the focus are basically on the stocks that have really been badly affected, and especially the index funds. And that's the reason why, in relative terms, the consumer fund has somewhat underperformed. But I think over the long term, as you open the economy, people will tend to spend, and this consumer sector, should also be one of the major beneficiaries of of the reopening of the economy.
I think one of the points that you highlighted there, Sir Ed, sir, for the benefit of our viewers also, is that when we talk of the consumer sector, it's not all equal. There are, as you
Yes,
said, companies that are into staples, and there are yung discretionaries, right?
yes,
So can we expound more on this for the benefit of our investor? When we
I
say
see.
staples, ano ba to, sir? And when we say discretionaries, ano yung mga companies na yan?
Well, in short, the consumer staples are basically those that provide services or goods that are the basic necessities. Okay, like in the likes of Universal Robina, it's primarily a consumer staple because it sells coffee, noodles, um, and well, those are the main major products. And you know, and for Century Food, basically they're into canned goods. So those are basically the those are the consumer staples or the basic necessities that the consumer acquires. So for this discretionary, these are basically more into as it has been described, discretionary. It means discretionary spending. Those that are um, those people that basically serves that in terms of more of discretionary spending or more on the wants serving the wants of a consumer, meaning let's say because of the improvement in the economy, you'll be more confident, let's say, in eating out, or you'll be more confident in buying more clothes. So in terms of needs, those they're not your basic needs, but more on those that you want. Um, so those are basically the main difference between a consumer staple and a consumer discretionary stock.
Thank you, sir. No, and from what I also got from you is that as a fund manager, that's where your value comes in, where even if it's a consumer fund, yun nga, there are differences within consumer companies, and it will be your view which companies you'll put more weight into, whether it's discretionary or staple. And then going into 2021, if I understand you correctly, you can still see growth because you have the consumer discretionary who
Yes,
will now be able to recover naman compared to the staples that already
yes.
ran up this year.
Yes, correct, correct. So, so what we're doing right now here, because let's say during the first at least first 3 quarters, you've seen the consumer staples na sila yung magbe-benefit. So, ang weighting namin sa consumer staples will be heavier, will be bigger. But once you've already started to reopen the economy, and there were because basically the consumer discretionary stocks will benefit from it, then we'll shift our investment from heavy on staples to discretionary. So in a way, that should allow the fund to perform well over the long run.
All right. So I think what I got from you, Sir Edser, is just because the fund already performed resiliently and quite well this year doesn't mean that it will already lag for next year, given its
Yes,
exposure that you still have yung
correct,
mga
correct.
discretionary going forward.
Yes, yes, correct. That is correct. Tama yan, tama yan. Kasi as a fund manager, we also have to, balance, make some changes on our portfolio, which yung tinitingnan namin kung alin yung it will outperform, it will, bring the fund perform well over beyond for next year. So as we said, that the reopening of the economy, which means, you know, people or the government will increase the capacity of people eating in the restaurants. And as you can see here, the latest jobless data, you've seen that bumababa na. So people will, be more confident. Hopefully, if this will things will continue, especially with the vaccine coming in. So people will, because of the increase in consumer confidence, then people will spend more in eating out and buying items, and that's where consumer discretionary stocks will benefit from.
All right. Thank you very much, Sir Edser, for sharing with us your insights on the consumption sector and your First Metro Consumer Fund. So later, sir, join us for the Q&A. For now, I'd like to move on to another fund manager. So we've already heard from Sir Edser about yung consumer stocks, and you've already had some sense of idea pagdating sa how fund managers do it. Now I want to go to Miguel and ask you, Miguel, thanks for joining us. No? At Philequity, kayo, you're pretty known for your funds being actively managed funds. Heading into 2021, how are you managing your portfolios? What are you seeing? And do you think there is still a lot of value to be had for an actively managed fund, especially for 2021?
Okay, good afternoon, Mark. Good afternoon, everyone. Okay. Okay, first off, I think the trajectory for the market is higher. Okay, just to explain to everyone, not only did the market fall significantly because of COVID, if you look at the stock market going back 5, 6 years, the stock market really hasn't gone anywhere for quite some time. And if earnings keep going up and the prices are not going anywhere, things actually are getting cheaper. Now, that said, you have to be selective. You can imagine because of the sharp drop due to COVID, where stocks are down anywhere between 25 to 60%, like anything's gonna go up, right? In the first phase because of the vaccine. And that's the game changer. The vaccine is the game changer. Okay, the second thing I want to remind people about is, for example, 3Q GDP came out below forecast, market went up. More than half of companies miss forecasts, market still went up. Um, COVID cases are still like there was a time it was above 2.5, close to 3,000. Market didn't crash anymore. So the reason is that the market is a forward-looking creature. It's looking at the future. So when the vaccine came in, that was really the catalyst that improved sentiment and gave investors a lot of hope. And that's where your upside comes from.
Yeah, thanks for that, Miguel. No, as I've mentioned, I think given your view, how do you now translate it to your fund, no? And let's talk about your funds. In terms of your strategy, halimbawa, this is a question that I get from people, no? Maybe you can help us answer this. If I'm looking at, for example, the Philequity Fund and the Philequity Dividend Yield Fund, how do you differentiate the two, and what kind of active management, shall we say, goes into these funds?
Okay, those two funds, while the benchmark is the same, is the PSEI, they are managed a bit differently in that the Philequity Dividend Yield Fund, while it still has a lot of blue chips in it, if you go down the list, there are more stocks there which are dividend payers than, say, growth stocks. Whereas a Philequity Fund would be kind of like the PSEI, but we change the weightings to generate outperformance. And there are also some non-index names there, but not in a very significant way. It's still benchmarked to the PSEI. So in theory and in practice, when the stock market goes down, you can expect the dividend yield fund to go down a lot less than the market and even the Philequity Fund. However, when things get better, and that's what happened during COVID. However, when things do improve and the market starts moving up, the Philequity Dividend Yield Fund, because it's more defensive, will underperform both the broad market and the Philequity Fund. So what you see in this slide here right now, this is actually the returns of the Philequity Fund going back to 1994. And really, most of the time, about maybe 70–80% of the time, we probably outperform on an annual basis. And the reason is that I'll use 2020 as an example, so it's more relevant. In the onset of COVID, and we noticed this in January, February, during conferences, people were not paying attention to COVID. So what we did then is we shifted to more defensive stocks, and we raised our cash levels. And then up around maybe latter part of third quarter, we were aware there would be vaccine results in November. We just didn't know it would be good. We were thinking like, 50 to 60% effectiveness, okay na. Kaso 94, 95, which is why the market is up so much, right? So we started reducing the defensive tilt and moving to cyclical. So that's something you can do in an actively managed fund. So like, for example, you'll see here on the left side, during the Asian financial crisis, we actually only lost 5% in the 1997. And then we actually outperformed the market by 25% the year after. You'll see the same in 2008. In 2008, medyo lang nagkamali kami dyan. We're down 40, but we're beating the market by 8%. But ours was the first mutual fund to go back to its all-time high after the 2008 US financial crisis. And that was because of the active management, the proper stock picking.
Yeah, thank you for that, Miguel. No? So, having said what you said about yung dividend yield and the Philequity Fund, for investors looking into 2021, how do you think should they appreciate the likes of a Philequity Dividend Yield Fund if you said that it could underperform, but at the same time, in terms of risk, hindi naman ganun kalaki yung risk niya?
Well, one thing we suggest to people is the same way in your portfolios where you diversify a bit. You can also diversify your fund holdings. You can have a dividend yield fund. You can have the Philequity flagship fund. You can even have an index fund. You can even buy the funds of the other speakers. That's okay. But if you're after pure return and your risk profile is high, like say someone like me, I would put it in the Philequity Fund. As if we think the market will continue moving higher next year, but no harm diversifying.
All right, thanks for that clarification. Miguel, since we're talking about yung flagship nyo, Philequity Fund, even the Dividend Yield Fund, I want to ask this question kasi over the years, Philequity Fund, in terms of its assets, has really grown. No, I think it's about 9 billion na ba, Miguel, if I'm not mistaken.
More than that,
More than
actually.
that, no, more than that.
Lot more.
So,
Yeah.
yung asset base na yan, based on your experience, is it more difficult to manage compared to, let's say, a Philequity Dividend Yield Fund, which is probably about 3 billion pesos in assets?
Yeah, it's a whole lot more difficult. In fact, we have funds which are much smaller, which are doing a lot better. But the Philequity Fund, because of the size, it's more difficult to manage because it's not easy to buy everything you want it's not easy to sell everything you want either. And if you notice, the volume in the market went from 7 billion plus per day down to 4 billion. So good luck when things go bad and you try selling. It gets pretty tough. And for example, let's say you like a non-index stock. If your fund is 1 billion, 100 million is 10%, right? But if your fund is 10 billion, 100 million is 1%. It's like that for if that doubles, yay, plus 1 percentage point to the portfolio. So the size becomes an issue as it gets bigger, and it actually becomes tougher to outperform.
Yeah, so in terms of that kind of nuance, for the Phil Equity Fund, so if I'm an investor going into 2021 and I'd like to look for an actively managed fund, can investors expect that the performance will not be as far compared to the PSEI? Is that the case?
It will. It's harder to generate significant outperformance over the PSEI. It's not impossible. It's just harder. Versus say a smaller fund. The smaller funds can be more nimble. The problem is, I mean, if you can imagine, Phil Equity wasn't a gargantuan fund when it started, but because it does well, more people go into the fund, then it becomes a big fund. Their portfolios increase in value because we're doing well, then it gets even bigger. So that is what happened.
Yeah, but aside from the thing that you mentioned, no, in terms of just the size itself, I think the other thing that I want to point out is you are still actively managing it in a sense that
Yes.
if let's say you feel like what happened this year, there are risks in the market, you can actually take off some exposure, and that will allow investors who are invested in your fund to manage the risk as well. So just because we're
Yes, yes.
saying na malapit siya sa index doesn't necessarily mean na laging index na rin yung performance niya.
No, no, no. In fact, at the highest point, I mean, at some point this year, our cash level was close to 20% already. And then now our cash levels probably 6. And that's only because there's 5% as a mutual fund that we need a minimum cash of 5%. So technically our cash is 1.
Yeah, so generally, Miguel, going into 2021, do you think active management is the way to go?
Okay. I'm tempted to say yes, but for all the viewers out there, active management is a function of is primarily a function of the fund manager. You only go for an actively managed fund if you trust the fund manager not only to outperform the market but to have your best interest in mind. Okay, that's the only reason you should go for an actively managed fund if you really trust that fund manager. So I just have to make that clear.
Okay, sige. Thanks a lot for your insights, Miguel. No? So I hope you guys who are viewing this, if you have any questions, again, like I mentioned, just type in sa Q&A tab natin sa Zoom and then sa Slido for our Facebook Live viewers. Let's take advantage of the fact that we have experts like Miguel, Sir Edser, and the other speakers who are still with us that they will be able to answer any query. So Miguel, join us sa Q&A later. Thanks for your insights.
Thank you, Mark. Stay safe, everyone.
Now, I'd like to go to Sir June Trinidad of ATR because as Miguel mentioned, no, if 2021 is something to be hopefully a better year in general, no, with the vaccine and all, and kagaya ng na-survey ko sa mga fund manager, there are pockets of opportunities in the market. Do we start looking at growth companies? And in general, no, paano ba tayo makaparticipate sa ganong type of exposure? Sir June, good afternoon. Thanks for joining us.
Yes, thank you, Mark. So maybe just a correction, kaibigan ko si June Trinidad.
Ay, sorry. June Tarrobago, sorry.
Okay. Magaling na economist din si June Trinidad at kaibigan natin
My
yan.
apologies.
Okay lang. Pero anyway, so the answer is yes because from my 26 years of experience, if there's anything I've learned in the market is that aside from you need to be humble, uh, it's that stock prices are driven uh, very, very, very much by earnings. And if you invest in companies with um, good management, quality management, meaning a good strategy, a good risk management platform, and a good strategy to generate consistent earnings growth, then you'll mostly like end up with a winner in the market. And the likes of I don't know, Wilcon and a couple of other small mid cap names are testament to that. Yeah,
Yeah. Sir, siguro if we can flash some of your slides. I understand you
sure.
want to share some outlook before you go
Uh,
into the fund itself, no? But maybe
yes,
if you can
again. So
highlight,
very quick. Yes,
yeah, the
Mark.
ones that are particular to the growth
Yeah.
sector that we're talking about, no?
Yes. Before you even start talking about and investing in growth, you have to first see that the if the economy is in better shape or in a recovery phase, or is it going down, I mean, still in a downward spiral. And maybe I added this slide because we wanted to lay the context of where the economy is. And basically what we're saying here is that there are visible, after the weak first half for obvious reasons, there have been visible sequential improvements in the third quarter, and in that's in the economy. So even the GDP number was showed a smaller drop compared to the second quarter, and we thought that was somehow an encouraging sign. In terms of the numbers that are coming out, were waiting for the unemployment number, which came out today at about 8-9% unemployment rate, and we thought that was actually quite good news because that was the last piece of economic data we were waiting for now, to give us a little bit of assurance that the worst case scenario for the Philippine economy is probably further away, meaning is actually, I'd go as far as saying, unlikely. And what is that? That the worst case scenario is actually a financial crisis in the banking sector because of bankruptcies and high spiraling unemployment, leading to another liquidity crisis and a crisis in the banking sector. That scenario, I think, has been shoved away, um, because if unemployment had actually gone back to around 16.7%, then that would mean a lot of balance sheets are in peril. A lot of bankruptcies have not been reported yet, that will be reported at some time and will imply liquidity issues in the market. But given that the unemployment rate has actually improved a little bit, to around 9% or 8%, which was reported today, gives us confidence that uh, the growth in the economy, the economy has not worsened, and that sequential improvements in sectors that we saw very clearly in the third quarter will continue and will ultimately translate into earnings growth for the company. So we're actually forecasting. I think in the next slide you see, if we can go to the next slide, improvements across sectors. You can go through this later on. In the following slide, we're seeing also a sequential improvement in core corporate earnings. So earnings, again, going back to earnings, the direction of stock market ultimately will depend on earnings. Earnings influenced by the economy, but at the end of the day, it's about earnings. And we saw earnings drop in the first quarter. Free earnings were in free fall mode in the second quarter, but there were some sequential improvements in the third quarter. And given the economic data that came out, we think the improvements are going to continue. So fundamentally speaking, the economy is improving. Earnings will be improving eventually. And then you also have in the next slide very low levels of foreign ownership, which we think will be is underappreciated by the market, because if and when foreign buying comes back, that's going to be in a big way, because it's I think we experienced record net foreign outflows recently, or in the past, in this year, or in the past years. That said, we're actually optimistic that the market could actually, given the economic improvements translating into corporate improvements, um, we're actually confident in the next slide that the market can actually reach 8,300 by the end of next year. And this is based on 19 times 2021 earnings. And this basically assumes earnings will not even go back to 2019 or pre-lockdown levels. We're assuming only that the earnings base, will reach around 86% of 2019 earnings. So if that's the case, we actually anticipate the market to be worth 19 times PE for the end of next year, why 19 times? The 5-year average I think is about 18 times without foreign buying. So if foreign buying comes back, the market can easily sustain the 18. Actually, should trade above 18, 19 times conservatively in our view, because of the improvements. And um, please note that during up cycles, usually companies in the conglomerate space, property, and consumer retail or discretionary perform. I think it was mentioned earlier. But more importantly, there are other sectors or other thematics that are actually combinations of those sectors. So the old way of looking at things is to look at the traditional sector, property, banks, and obviously that still works. But I guess our point is, the people like using the term the new normal. Well, I'm actually not a fan of saying the new normal, because I think things will actually be better because there's so many lessons from this year. And that being the case, the old way of looking at sectors is actually still okay, still effective, but there are emerging thematics that are coming to the fore in the market. And in the next slide, yes, please, next slide. Well, one of the ways to play this expected surge over the next 12, 18 months is, at least from our perspective, is the Alpha Opportunity Fund. It doesn't have that long a track record, but I think the most important thing is to look at the most recent track record of the fund, because over the last 5 years, this has actually outperformed quite a bit, both the small cap index and the Philippine composite index, quite significantly, I would say, even on a total return basis. So how did we do this? And obviously the strategy is to sustain, if not even build on this outperformance for the Alpha Opportunity Fund. This is also a multi-awarded fund, commended by the CFA Society of the Philippines as the best managed equity fund last year. And again, so maybe in the next slide, let's talk about. So we attribute the outperformance of this fund over the last 5 years to a consistent investment process. We can have good calls, we can have bad calls, we can swing for the fences, and totally and have a good year. But to have consistent outperformance, especially now, is the point wherein yes, the old dynamics are still there, but the economies and the markets are actually changing, and everyone is behooved to adjust and adapt, and this fund has a proven capability of being able to adapt over what is emerging as the new economy. In the US, they pertain to the new economy as tech and all that. But if you really think about it, the Philippine economy is actually evolving, and we'll talk a little bit more about that later in the thematics that we're saying. So what is the process? How did this? We like to think that this fund has outperformed consistently because the process is repeatable. Again, we're not relying on a few names. It's a consistent process anchored on a deep platform of equity research. We have a dedicated internal equities research team covering 10 sectors intensively. And last year we did 350 company visits. I mean, who does that? I'm not sure who has the passion to do that, but I mean that's our approach. I mean, because if we employ a full court press on the companies, because I think we owe it to investors. So if you want to trust us, I think Miguel talked about trust. I agree, that's a very important point, and I think you can trust us because we do full court presses on companies. We make sure we know the companies inside out. We make sure that we're kept abreast of developments, and we have an investment process rooted in deep fundamental research that allows us to identify the fastest growing companies, the future blue chips, and the deep value opportunities in the market. Aside from that, risk management is embedded in the platform. This basically allows the fund to identify red flags and avoid potential disasters. So people are kind of averse to a small mid cap growth or a growth fund because they think it's risky. I think we've proven we've been able to. We've presented that the risk management platform of this fund, which is embedded in the process, has allowed us to really consistently outperform even during bad years. The guidance for this portfolio, myself and our CIO Philip Hagedorn, is a combined 50 years. So we're not spring chickens. We're not young. Combined 50 years of combined experience in Philippine equities. Next slide, please.
Yeah, Sir June, if you don't mind, no, I just have a question about
Sure.
the
Kala ko sabi mo time up na eh. May
risk
one slide pa
management.
tayo. Yeah,
Yeah, just about the risk management aspect. Kasi
sure.
I don't know if the investors are really looking at the performances, but the past month alone, it was a spectacular performance for the ATRAM Alpha Opportunity Fund. But for the most part of the year, given what happened to the pandemic, I think the small caps, mid caps, and growth companies were the ones mostly hit. And there were some years that that was also the case, but there were some years where growth companies were the stars, so to speak. So if I'm an investor looking at the Atram Alpha Opportunity Fund, is it fair to say that the nature of this fund is really such na yun, it's thematic. So if growth companies are in, expect spectacular performance. If not, then probably struggle.
Um, the I think the answer to that question is this is not dependent on growth per se because this is a fund that is very targeted. It's not an index fund that is broad-based investing in the index. This fund goes in areas of the economy or invests in areas of the economy where there is either there is potential growth because there is a special situation, there's a turnaround, there is a strategy that is very viable that will generate growth, and it doesn't turn away from opportunities when there are ridiculous deep value opportunities. It will take advantage of that because at the end of the day, our mission is to generate alpha or outperformance or returns for the customers. And it's actually a great question to segue into the last slide, Mark, because here the what I get asked always is how do you keep that outperformance? How do you continue the outperformance? How do you sustain it? And from what we've laid out earlier, that the economy is improving, that sectors are slowly recovering, but that the market, the general index names have actually run already, at least most of them. There are significant pricing inefficiencies in certain areas in the market that are not given full attention by everyone because either they're too small or they're a new name. But going back to the theme earlier of old economy transitioning into new economy, which I think the Philippines is on its way toward, we think that the strategy to sustain our outperformance, which has been quite significant, not just last month. You mentioned last month, yes, but maybe just to add to that, the outperformance is for me not surprising. With all modesty aside, it's big. The outperformance is expected because we don't anticipate our ideas, our stock ideas, to materialize immediately. Sometimes these ideas take time to play themselves out. And what simply happened last month was there was a culmination of good news, and those were things we anticipated, and that's why we weren't really that surprised with the outperformance because we're investing for the long term, and these are ideas that are not just for tomorrow or the following month. It's really for the long term. And maybe segueing into how we will sustain the outperform we plan to sustain the outperformance. It's Well, first of all, because of the outlook I mentioned earlier, you're talking about at least an 18% return on the Philippine Composite Index or on the market if you invest in the market per se. But if you look at the pricing inefficiencies in the market, I think they're most pronounced in the growth sectors right now. So the answer to how do you sustain the outperformance, it's invest in growth. So to do that, first we reduced our cash to significantly lower levels. Second, we find growth opportunities and we investing in those growth opportunities in three strong themes, which are number one, reopening beneficiaries. So I think half of the portfolio, around half, is invested in those reopening opportunities. And we're talking about gaming, consumer discretionary, as mentioned earlier, property that are showing companies that are showing clear turnarounds, and construction is going to be a strong theme for next year. It has to be, otherwise the whole economy will fall back, won't grow as much as everyone or the government thinks the economy is going to grow. So reopening themes. Second is ESG champions. ESG is a trend that is not just sweeping the globe, but it's also very relevant. It's becoming more relevant to us. And those areas will command a premium, we think, later on. Actually, one company we have that is what we consider an ESG champion is AC Energy, and that's done quite well for the fund. So and that's not in the index. So this is a way of capturing the investing in the Alpha Opportunity Fund gives you a way to capture those themes. And then lastly, ESG champions were pertaining here in environmental companies, renewable energy companies, and water companies, and also new economy drivers. I don't. You have an indirect, a quasi play on a new economy driver through the index, some index companies, but to have a play on a pure broadband, pure fixed broadband company is not in the index. And this is a vehicle for accessing that key driver of the new economy. Logistics also is another key driver of the new economy as the Philippine economy shifts or slowly transitions from the old industries into tech and the new economy. And also, we're not turning a blind eye to deep value opportunities. When certain large caps hit small cap market cap levels are reduced, we will not hesitate to pounce. Actually, GT Capital at some point was sold down to 60 billion pesos in market cap. This fund this fund is capable of taking advantage of that mispricing in the market. And now the market cap of GT Cap is above 100 billion again, and the fund has benefited from that. So it's again investing in now to sustain the alpha or the outperformance. We're investing in reopening beneficiaries in a big way, ESG champions or environmental, social, and governance champions, and new economy drivers, fixed broadband and renewable energy and fixed broadband and logistics.
Yeah,
So
thank you very much, Sir Juno. I think the way you describe your focus for the Alpha Opportunity Fund, it really cuts across different sectors. And as you said, itong major themes mo. And from what I got from even the previous speakers, I think our investors at the end of the day would just really have to choose the type of fund that they feel will best fit maybe the risk profile or even their own personal view so that they can really ride whatever growth we may see in 2021. So, Sir June Tarrobago, thank you for sharing with us your insights. So, join us later, sir, for
welcome,
the
Mike. My
Q&A.
pleasure. Thank
Yeah,
you.
so we've heard from Sir June more on the different teams, especially for the small mid-cap companies. Now, I'd like to pull it back, the discussion, to the larger ones, to index names, and let's see if there are still opportunities for companies like this. So, can I have Miss Gabs, Miss Cristina Gabaldon with me? Hi, Miss Gabs. Good afternoon.
Hello. Hi, Mark. Hi, everyone.
Yeah, Miss Gabs. So, as I was saying, no, I'm now curious, given the views of the previous speakers. When we talk of index names, are there still opportunities there? And if there are, based on how you manage your Sun Life Prosperity Philippine Equity Fund, how do you take advantage of these opportunities?
Okay, so the way we manage our fund is we are cognizant of the benchmark. So it's an enhanced indexing approach wherein we tilt plus minus 3% on names that we like and we don't like. So opportunities, yes, we still see opportunities, particularly in the telco sector, the property sector, consumer and gaming, and the transport sector. And then there are particular companies we like in those sectors.
Yeah, Miss Gab, maybe you can share with us your view from your slides and talk to us more about the companies that you're talking about. And then, yun nga, in terms of you putting more weight or you in terms of your fund management, how do you do it? Yung plus 3%, does it change when also your view changes?
So, okay, let's go through some of the market drivers. I know you've gone through this earlier, but I think one thing you did not particularly point out is the earnings yield to bond yield we are seeing right now. Earnings yield of the market, that's the reverse of the PE, is 6% versus the net bond yield of 2.3%. With that kind of spread, uh, that's a good enough premium to go into the equity market. Typically, a spread of 200 bips is attractive enough, but this is way more than that. So that's what I want to highlight on the drivers of the market, aside from explained earlier. But we put more weight on the positives now compared to the negatives highlighted in my slides.
In other words, Ms. Gabs, just want to highlight that point. No, for those investors who may not be too familiar with the jargons, when we talk of yields, fixed income or interest rate, usually meron kang, as you said, ano yan, 2%, 3%, no? So that's the decent returns that we're expecting for a fixed income instrument. Now,
So we
looking at
compare the earnings yield to the 10-year bond yield, and we net that with the 20% tax.
And that goes to show that it's really more attractive if from a return perspective to put your money in stocks compared to fixed income at this point.
Correct.
Yeah, so given that view, Ms. Gabs, like as I was saying, are there still opportunities for index names? Or how do you eke out outperformance, let's say, versus the index, given this kind of environment heading into 2021?
It depends on the companies. You have to look at individual companies and the sector wherein those companies operate in. So for us, like in the telco sector, we actually are overweight on both names. We see, without giving so much on what we have in the portfolio, we like the broadband segment. Next year, we're looking out that one of the telco companies is coming off a low base and could surprise, especially as the economy reopens. On the property sector, we like names with less OGO exposure. We look at the valuation of these companies. We look at the trajectory of the recovery. We look at quarterly earnings, how it is improving sequentially. For consumer and gaming, for the gaming sector, there are developments like online betting might be allowed, although the rules are not yet out. For consumer, it's right now, if we are playing the reopening theme, then like Edser said, it's from staples to discretionary. For the transport sector, it's recovery of global trade for us.
Yeah. Thank you for giving us an idea, Ms. Gabs, as to how you view the landscape right now, no, in terms of the market. I'd like to also ask you this question that I earlier asked kay Miguel. Sun Life being one of the largest asset managers in the country, you manage billions of pesos in the fund. Now, focusing on the Sun Life Prosperity Equity Fund, for instance, do you also find it challenging to have a big fund in a sense that given the themes that you're saying, how do you apply yung views nyo to this fund?
So managing a big fund is, uh, I guess, more challenging than managing a smaller fund, but it also has its advantages. Given your size, you could be more efficient in trading. You can consolidate orders across portfolios and get better rates. Also, because of size, the sell side, such as yourselves, would pay more attention to you and give you better quality research.
Yeah, so it doesn't just necessarily mean that with size comes well issues in terms of
Difficulty or issues.
nimbleness. Yeah, but
Yes,
you also have advantages, no, as a
correct.
fund manager that
That's
that
right.
will yeah that will benefit ultimately the investors. So Miss Gabs, for clients who are currently invested in the Sun Life equity fund, no, going into 2021, based on what you said, you're looking at different teams, looking at place where you can put more emphasis on. What kind of risk and return profile do you think can they expect for 2021 for Sun Life investors?
Mm. So, given how we manage the fund, we stick close to the benchmark, right? So, returns wise, it won't deviate so much. As to risk, we pick the better quality company in each sector that we like. So it kind of manages the risk in case, the negatives creep up, like COVID cases resurging again, or a further slowdown in consumer and infra spending, those things. We are sort of hedged for those downside.
Mhm. So in terms of Miss Gabs, I'm curious, going into 2021, are you positioning the fund to be more of okay, we're not going to veer too much away from the index, that's a given. But are you more defensive or are you taking it more aggressively based on your view?
Like I said, I would give more weight on the positives at this point, and so we are positioning for that upside or the reopening theme in the economy.
So does it follow, Miss Gabs, na recently you're deploying your cash, the cash of Sun Life Equity Fund into the themes that you're seeing?
The way we manage cash, it's like almost at 5%. So it's through the stock selection or the overweighting and underweighting that we derive our alpha.
Yeah, and let me be clear with that, Ms. Gabs, no, for the benefit of our investors. Yung alpha that we're talking about or the outperformance, is it only constrained within index names or do you also have some space to look into the smaller ones that you can include in your fund?
We definitely look at the smaller names as well. That's where you get your alpha, and aside from the overweighting and underweighting, so we don't overlook those smaller cap names. As long as it has potential, then it belongs in our fund.
All right, thank you, Ms. Gabs. No? So from what I gathered from you, while there are opportunities talaga for the market, we still have to be quite discriminating even for blue chips. No? There are teams, as you said, na you can put more weight on the positives. And to a certain degree, you also look at smaller companies, not just the index one. So thank you for your insights, Ms. Gab. So like I said, for those of you who have any questions for our fund managers, for Ms. Gabs, later on, we'll still have her for our Q&A. Thank you, Ms. Gabs.
Thank you.
So let me now go on to our last expert, last but definitely not the least. So I've been talking about yung index names earlier, and I've shown you a quick recap of how the market has performed since we found ourselves at the bottom nung March. And so handsomely, objectively speaking, maganda na rin yung rewards ng index. So Mike, can you tell us more about yung prospects of an indexing strategy for next year? Do you think it's something that investors can still buy into? Or dapat medyo we will still have our index but start looking at other strategies as some of our experts have already mentioned?
Hi, Mark. Hi, everyone. Good afternoon, and thank you for inviting us here. So with regards to the question, no, I guess going into the index fund, you'd go into the index fund if you really think that the market is going to move up higher, no. So I guess based on what the other speakers have said, we're still a little bit bullish going into next year. So I think there's still some room to move to get into that fund and reap the benefits of the market moving higher.
Yeah, and like I said, Mike, no, yung indexing kasi it's something that is a core for most of our clients. Now, do you feel that, for instance, yung Philippine Stock Index Fund, the way it's being managed is really just tied to the index. It's something that going forward, people can just put their money into, forget about it. Yung mga teams, let the other investors do it. And for most, dito na lang sila. Does it work that way, especially for next year?
Yes, maybe we can go to the first slide. Yes, so here, I guess as you mentioned, no, when you hear index fund or index investing, what first comes to mind for seasoned traders and long-time investors in equities, I think boring or plain come up easily, no? So why put money in index when you can just replicate, right, and choose the stocks that you only want or think will perform well? Well, this chart will try to disprove that. So we have here the PSIF or the Philippine Stock Index Fund, BMIS Fund, our fund, index fund, no, along with other active funds here that are unnamed. Clearly, the chart shows over the long term, 7-8 years, this index fund outperformed several active funds. In fact, it ranks in the top three in several calendar years in terms of returns. So not so boring and plain after all, right?
Mm-hmm, mm-hmm.
So yeah,
Yeah, so,
um,
yeah,
yeah.
go ahead, Mike. Sorry.
Okay. So I guess just to go into that deeper, no. So what's the reasoning behind this performance or outperformance, you might ask? First off, index funds are cheaper. These funds are typically charge only 1% management fee. On that alone, all else the same, you can get an additional 0.5% or 1% compared to an active fund in return. Also, mutual fund regulation prevents actively managed funds from going beyond 95%. So when the market is moving up, naturally the tendency is that 5% cash that an active fund is holding will drag performance. Whereas an index tracker, given its mandate to replicate the index performance, there's no such rule to hold as much cash, no? So fund managers, as smart as we think we are, of course, are prone to make mistakes. And that's the second advantage of an index fund. Whether if the market is up or down, we always get compared to the PSEI or whatever index depending on the fund type, because that is what we strive to beat. No, it is the benchmark or measuring stick upon which every fund manager's performance is compared with. It cannot make mistakes because it is the standard. It is always correct, so to say. An active fund manager may be looking at target prices or price to earnings multiple and may decide not to own a stock or go underweight because it is looking expensive na. Well, that certainly has not stopped our market from performing strongly this last few weeks, has it?
Yeah.
So despite earnings weakness, rich valuations, GDP contraction, the market kept moving higher. An active manager may become cautious and about these movements, no, with stocks hitting or going above target prices. However, an index fund will not discriminate, so it has no choice but to remain invested. So if markets do move up higher still, an index fund will not make the potential human error of an active manager.
Yeah, let me ask this question, Mike. No, very interesting points that you made. So, in your opinion, in what instances would an index fund not be a good strategy?
Okay, so that's an excellent question. I think we can move on to my next slide here. So I don't want to be, it's not really index fund is not really perfect, so to say. So now that we have seen the advantages or that I've mentioned the advantages of the index fund, I wouldn't just count out active funds still when deciding to invest. So while index funds, sure has its advantages, It doesn't mean that there's no more room for actively managed funds in this market. I think they can, or rather will continue to coexist with one another, because there are also advantages to putting money into the active funds. So for one, actively managed funds can raise cash when the fund manager sees the market is headed down, or simply add more weight into defensive names like utilities and telecoms. So as to your question, a perfect example is this year, 2020, So when you go around and look for fund performance, I bet most active funds will be posting better returns or less negative returns than index for the year-to-date period. And
Mhm.
that's because of the flexibility of being actively managed. So when the market was going down, actives are decreasing exposure in the equities market. It is not uncommon to see cash levels back then at around 10 to 20%, given the uncertainty of the economy and the market. Meanwhile, index funds being indexed cannot replicate that, because they need to be fully invested and track the market performance. So I think anytime the market is headed south, more often than not, actives will be a better choice over index.
Yeah.
And
So
then
go ahead, Mike.
go ahead. I mean, I'm just gonna add some more. I guess jumping off from June and Miguel's and Gab's presentation earlier. No, so index funds are stock with index names, investing in index names. So it'll miss out on stocks that are not part of the PSEI. So we had a couple of those in the past, the likes of Wilcon, Century Pacific, DNL, and everyone's favorite nowadays, AC Energy. So those kinds of companies, no, the index will not be able to enjoy having, or at least not until they get included in the PSEI. The index having mostly the biggest and most mature companies in there, those companies will likely tend to have lower growth potential in terms of earnings compared to smaller companies. It is a lot easier to double a million peso company in terms of revenue than a double 10 billion company, right? So actives, they can opt to invest in these names and capture that growth potential for that fund.
Yeah, and from what you're saying, Mike, there's really room for both index and active management, right? But let me ask you, personally, going into next year, do you think indexing should have more weight, or should we have more weight in terms of the active strategy?
Well, I guess just based on the first slide, that's like a long period to cover, no? So parang it shows that index funds, or the index fund is, it performs really well. And given nga that the outlook right now is sort of promising with the potential of fund flows coming in, and the distribution of the vaccine by maybe second half next year. So especially during up cycles, no, I mean the market during periods of the market going up, then I think the index is still a fund that you might consider going to 2021.
Okay, so yeah, so personally, Mike, as I was saying, would you be more index next year, or would you put more weight on active, given just what you said? Mm.
So with the foreign fund flows, I think it'll still be more of the big cap, so index name. So yeah, I'll be more, I'd say index for me.
All right, all right. So I think what's clear, Mike, as you mentioned and as we've learned from the previous experts, there are themes, there are pockets of opportunities that can be taken advantage of by investors. But at the same time, having an index is also a proven strategy. And it's not always an either or question, right? Kasi dito sa COL, to share with you, Mike, we're always asked, if I invest in an index fund, should I still invest in other types of funds? And I think as what you said, there's always a room for an active management. So thanks a lot for enlightening us about the prospects of an index funds and generally what index funds do, the pros and cons, and how they compare with the active management. Thank you, Mike. At this point, we've all heard from the different fund managers, from our experts. And like as I was saying with Mike now, nakita natin there are different strategies, different types of funds that will allow us to participate in the stock market. And at the end of the day, it's a matter of choosing which ones we feel will best fit our risk profile, our own view, maybe to a certain degree. And so, talagang marami kang mapagpipilian dyan. And the only thing that you really need to do is to make sure that you're going to participate in this market given the 2021 view of our fund managers.